Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. The market continues to be kind of Mr. Toad's wild ride, if you will. By the way, an alert listener pointing out to me that ride no longer actually exists at Disney. So I am showing my age. I was born in the 1900s. So there you go. S&P 500 right at about 5492. That's down about 6.4% for the year on a level wise, which is actually a lot better than we were at the beginning of last week. S&P 500 staging an impressive sort of 4.5%, 4.6% to be precise, gain last week for reasons that we'll talk about a little bit later in the update. The other thing that I would just note is that, for a number of years, we would just sort of talk about price level in terms of overall return. In today's environment, you actually want to incorporate the sort of dividend yield, or in this case, interest payment yield, because those dividend yields and interest payments yields actually are quite high on an absolute basis. And so if you were to look at the S&P 500 in terms of total return, you'd see about a minus 5.7% number year to date. Bonds on the other side of that up about 2.7% year to date, including interest. So if you've got kind of that classic 60-40 portfolio, if it was a basic 60% S&P 500, 40% Barclays Ag, you'd be down about 2.3% year to date, including dividends and interest, which really isn't all that bad. Honestly, if you surveyed most people and asked them where they were after all the carnage that has gone on in the marketplace, I'm guessing that most people wouldn't say, yeah, I'm down less than 2.5%. By the way, that 2.5% number is potentially even better if you start to factor in some things in your equity exposure like international, et cetera, et cetera. But I digress. That obviously depends on how your portfolio is constructed. So it does highlight a little bit some of the volatility that we've seen recently, the importance of staying the course with your portfolio. So, obviously we saw a very dramatic sell-off, 2 days where we were down 5% both days, and then a flat day, and then another day where we were up 10. And, last week was up 4.5% after a series of weeks where we had shed a significant amount of market value. Those massive intraday swings are just a playground to make mistakes with your portfolio. If you decide to try and get out or market time or make decisions about reweighting, you can really miss the upswing on the other side. And so we really just encourage people when we get into these periods of volatility to just sort of stay the course. This is the reason why most of your portfolios are built the way they are. And normally, we talk about all the different things. Your investment portfolio is like a bar of soap. The more you touch of it, the less of it there is. When you get the decision, the sort of inclination to make a decision that in the heat of the moment, that decision is normally wrong. All of those things can be sort of encapsulated and summed up by the past sort of month in the marketplace. This week is a very busy one. We are in the middle of earnings season. We've had about 180 companies in the S&P 500 report so far. And results have actually been quite good. Net income is up about 17.5% year over year versus expectations about plus 7%. I will say that there is some mix shift in this particular number. Sometimes your sort of techie companies tend to report at the beginning of the quarter, and then you get more mainline companies towards the end of the quarter. Just because we're plus 17 versus a plus 7 expectation doesn't necessarily mean that we'll stay there. We still have about 65% of the S&P 500 that still needs to report. And a lot of them are going to report this week. We've got about 43% of the S&P 500 that will be reporting earnings this week. I would say that some of the strength that we saw in the S&P 500 last week was actually a result of companies coming forward and sort of explaining their outlook and take on tariffs, which is actually a little bit more positive than some people thought. As we've talked about previously, the market doesn't deal with uncertainty well. Hearing companies sort of come out and say, okay, this is going to be somewhat manageable. Here's our contingency plan for how we're going to deal with this. Here's what our maybe estimates are for the back half of the year. That's comforting information that the market has sort of taken to say, look, so long as the tariffs aren't, as long as we're not careening down this path of just shutting down trade totally, companies seem to be able to deal somewhat with the level of tariffs that are currently in place. I think the market taking a decent amount of comfort from that. We also have a number of macro data points coming out later this week. So very busy week for the markets. We've got consumer confidence on Tuesday. Really everybody focused on the consumer, trying to figure out how they are feeling after a very topsy-turvy, April or late March. We've got PCE, personal consumption expenditures, coming out on Wednesday. And then on Friday, we have an unemployment report coming out, or an employment report coming out, where all eyes will be on that employment report to kind of divine where the Fed might be comfortable next. Most people expecting that sort of unemployment rate to hang in the low fours, 4.1, 4.2%, but we will see. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.